Within the next 2 decades, temperatures are likely to rise by more than 1.5 degrees Celsius above pre-industrial levels, bringing widespread devastation and extreme weather events. Only rapid and drastic reductions in greenhouse gases can mitigate climate change, with every fraction of a degree likely to exacerbate the accelerating effects. The transportation sector is the largest contributor of greenhouse gas emissions, making up 27% of the 5.2 billion metric tons of CO2 in 2020. Specifically within the transportation sector, medium and heavy-duty trucks made up 26% of greenhouse gas emissions. In the past decade, technology development in battery and charging infrastructure has drastically decreased the total cost of ownership and barriers to entry, where electric vehicles are finally competitive with internal combustion engine vehicles. With the promise of a green transition in transportation, the SPAC Wave of late 2020 and early 2021 brought many early-stage electric vehicle companies into the public markets as clean tech and sustainable companies came into vogue. Failing to meet lofty expectations, with some companies even facing fraud allegations or securities violations, the euphoria has since reversed for many public electric vehicle companies lacking a key differentiator in fundamental technology and partnerships, along with long timelines to ramp production. Despite a wide field of competing electric vehicle companies, the current market has mostly focused either on smaller passenger or larger heavy-duty vehicles, and there is yet to be a leading company with differentiated components suited specifically for the medium-duty electric segment. Within the realm of commercial vehicles, the heavy-duty segment presents difficulties with batteries requiring a longer range and energy storage for interstate or intercity applications. Thus, many heavy-duty solutions to decarbonize the segment may come from alternative fuels like hydrogen or natural gas. For this reason, we'll be focusing on medium-duty vehicles with applications for short-range commercial transport and last-mile delivery that is more prime for electrification. The vehicle market is broken up into 8 classes of vehicles classified by size. The US electric medium-duty vehicle market is a $15.5 billion opportunity, composed of Class 4 to 6 vehicles, primarily used in the last-mile delivery space. The commercial electric vehicle market is estimated to grow at a 5.3% rate over the next 5 years as the increasing number of construction and e-commerce activities lead to an increase in demand for material transportation, with growth shifting toward electric vehicles. First, a brief primer on how electric vehicles work in comparison to internal combustion engine vehicles, and how they benefit the environment. A vehicle can be broken down into a body and its chassis. The chassis, the vehicle's frame, incorporates the crucial components for movement, with the engine's power delivered through the transmission system in the form of rotary motion and to the live axle or axles that rotate the wheels at the end. The main difference with electric vehicles is that an electric engine and battery replaces the internal combustion engine and requires 90% fewer moving parts. Not only do electric vehicles lower fuel and maintenance costs, but in concept, decarbonizes the transportation sector with zero tailpipe emissions. Going back to the main economic selling point of operational improvement, commercial fleets typically look at the total cost of ownership between electric vehicles compared to combustion engine vehicles. Typically, electric vehicles sell at a premium compared to internal combustion engine vehicles. To make a buying decision, the operational savings from lower maintenance and fuel costs over the estimated life of the vehicles must be significant enough over the electric premium. In effect, higher fossil fuel prices encourage electric vehicle purchases, while lower prices do the opposite. Additionally, vehicles must reach a sufficient range of miles along with this energy storage, charging infrastructure, and operations. Charging is particularly difficult for heavy-duty vehicles traveling larger distances, city to city or state to state, over multiple shifts with an inconsistent place to park at stops. In contrast, medium-duty vehicles, especially within last-mile delivery, travel within a certain inner-city area. Lending itself well to charging operations, medium-duty vehicles are typically single-shift vehicles that run constantly for 6 to 9 hours. Medium-duty vehicles are then parked at the same depot during off-shift hours, allowing for an 8 to 10 hour charging window daily at an industrial site with sufficient electric infrastructure for charging installations. When looking at areas ripe for electrification, the medium-duty delivery segment is perhaps the best suited, with mostly set, predefined routes of known distance and mileage that end with the vans back at a central location for recharging. From mid-2017 to mid-2019, Tesla had faced severe stress in bringing the Model 3 to mass production. Elon Musk had noted that the company was on the brink of bankruptcy with 1 month's cash left at its worst. Capital intensive with high barriers to entry, the automotive industry was composed of mature companies with established car production for internal combustion engine vehicles, but not for battery-powered electric vehicles. The industry was primed for electrification, but no automotive brand had ever proven a profitable business by focusing solely on producing electric vehicles. In 2020, Tesla finally achieved its first profitable year, led by sales of its Model 3 and Model Y electric vehicles, with a record annual revenue of $31.5 billion. Notably, sales of pollution credits were a key driver of profitability, but the company had proven to public markets that it could scale production to over 1 million vehicles annually and in the black. The pure-play electric vehicle model in the passenger car segment had been validated in the public markets by Tesla after years of production hell, and the floodgates opened for new competition eager to electrify transportation in the medium and heavy-duty segments. Further increasing investor appetite for electric vehicle companies were low interest rates, an increased money supply, and federal stimulus to address the slowdown of the economy during the pandemic era. Low interest rates supercharged the equity market, especially for growth stocks, and fostered an environment ripe for companies to go public, as investments with longer time horizons to reach profitability could achieve higher valuations due to a lower discount rate. EV startups were now eager to raise capital in the public markets, but traditional IPOs had more stringent underwriting standards. An investment vehicle soon emerged in popularity for less developed companies to go public. Special purpose acquisition companies, also known as blank check companies, were public investment vehicles that raised money in trust, led by a financial sponsor, to acquire a target company in which the merged entity would effectively bring the target public. Companies were now presented with a new path to raise capital with more lenient standards. In March 2020, the first notable vehicle startup to go public through a SPAC was a hydrogen fuel cell truck company in its pre-production phase, Nikola. The company went through a reverse merger with Vecto IQ Acquisition Corporation at a $3.3 billion enterprise value, closing in June 2020. With claims of fully working alpha prototype trucks running on hydrogen with zero emissions, the stock exploded soon after to a price per share of $65.90 at closing on June 19, 2020, implying a $25.8 billion enterprise value for a company that had not delivered a single vehicle to any customer. Investor appetite for early-stage companies was apparent, and a flood of clean tech and electric vehicle startups soon followed at elevated valuations in the public markets. SPAC investor presentations frame valuation in terms of forecasted revenue years into the future. For a pre-production company with no vehicles on the road, how accurate could these projections be? Laughably optimistic. You can supply the NHL with all of the hockey stick forecasts. Low revenue multiples in future years compared to high revenue multiples in the current year implies astronomical growth in the time in between. This forces ambitious execution with sky-high expectations from investors. We'll talk more about that later in the video, but first, let's dive into how EV startups generally operate. Electric vehicle companies generate revenue from sales of vehicles. Simple enough, right? The hard part is executing this profitably. To be successful, players in the industry must sell cars with favorable unit economics at a large enough scale to exceed the fixed and variable costs of production. In ramping up production, industry players must balance a trade-off in their strategy between owning their production capacity, involving higher capital expenditure, and working with partners to source and assemble vehicle components, involving higher variable expenses in cost of goods sold and operating expenses. A high capital expenditure strategy provides long-term stability in the supply chain with ownership of components and increased control over gross margin profiles and production times, as the bill of materials for vehicles is less exposed to third-party supplier risk, but requires significant capital to execute over a much longer ramp-up period. This strategy presents high barriers to entry against mature incumbents with established manufacturing capacity and vertical integration, when startups can likely only execute on one key differentiator or focus on one segment of the market at a time. Conversely, a quicker ramp-up strategy would rely on partnerships and third-party suppliers for the production and assembly of parts, with the company focusing on one or very few aspects of the supply chain. The strategy is advantageous for going to market quicker with established capacity of suppliers, and has typically been the option electric vehicle startups have chosen. While results are easily realized in the short term, relying too heavily on suppliers and racing to assemble electric vehicles can expose players to more supply chain risks and both increased prices and delays. The company also loses its technological moat. An established automotive company could easily replicate the strategy with its Rolodex of Tier 1 and Tier 2 suppliers at its disposal. Ultimately, the EV startups that will last will create a defensible innovation that will increase the performance or decrease the cost of the vehicle dramatically. Unfortunately, in the race to bring a vehicle to market, many EV companies that went into the public markets too early chose a heavier supplier model. In effect, many of these players lack technology defensibility that will allow them to compete in the long term. With production covered, there's a key difference between the customer acquisition strategies between passenger vehicles and medium or heavy duty vehicles to actually sell the cars. Passenger vehicles are business to consumer with a dealership or direct to consumer model for single vehicle purchases, while medium and heavy duty vehicles are business to business with EV companies selling multiple vehicles at a time to fleet managers. Medium and heavy duty vehicle players typically negotiate contracts with enterprise customers for larger bulk orders of vehicles, generating stickier customer relationships. This generates higher switching costs for fleet customers who come under contract, as they may also require a certain specification or model to meet their needs. Within medium-duty electric vehicles, there are two main players: EV startups and legacy automotive and OEM companies. Among EV SPACs, there were companies that went public at a pre-revenue stage and still had not reached volume production at scale. Based in the UK, Arrival is a manufacturer of commercial electric vehicle vans and buses. Arrival touted its competitive advantages of using a microfactory model with proprietary composite materials and its modular skateboard design for its chassis. The company currently has a York County, South Carolina microfactory to produce buses and is looking to build its second US microfactory to produce electric delivery vans. Arrival initially demonstrated its traction in its partnerships with its signed contract with UPS for 10,000 delivery vans, along with strategic investments from Hyundai and Kia to collaborate on developing electric vehicles. Spun out of Faraday Future in 2017 and initially headquartered in Torrance, California, Canoo is a designer and manufacturer of electric vehicles for both commercial and consumer markets. The company, like Arrival, also attempted to differentiate itself with its skateboard technology to offer a modular chassis to manufacture a wide range of vehicles with maximized space and a low profile in its form factor. There were also companies who had existing vehicle production, but not quite at scale yet and highly reliant on third-party suppliers. Lightning eMotors is a manufacturer of electric fleet medium and heavy-duty vehicles, including delivery trucks, shuttle buses, passenger vans, chassis cab models, and city transit buses. In its SPAC presentation, Lightning eMotors had 120 vehicles sold, with assembly factories operational since 2018, along with proprietary transmission in its chassis. But it seems that it procures most of the other vehicle's components from third-party suppliers. In May 2022, Bluebird Corporation unveiled a Class 5-6 electric vehicle chassis powered by Lightning eMotors. Based in Montreal, Canada, Lion Electric is a manufacturer of all-electric Class 5-8 commercial urban trucks and buses. As of Q3 2022, the company has delivered over 800 vehicles and sold 156 vehicles for the quarter. Lion Electric is currently dependent on third-party suppliers as well for its chassis and body, but owns battery system technology to produce its vehicles and is working on building its own battery plant in Montreal and manufacturing facility in Joliet, Illinois. Finally, ZOS Trucks is an electric mobility company that designs and develops Class 5-8 electric vehicles and powertrains specifically for commercial fleets. The company's primary focus is on medium and heavy-duty commercial vehicles that travel on last-mile routes. ZOS operates as a conversion player, sourcing most electric vehicle parts from third-party suppliers with vehicles on the road since 2018. In Q3 2022, the company delivered 88 vehicles. EV startups face competition not from just each other, but also established auto companies with new subsidiaries focused on electric vehicles. These companies use components in their diesel-powered vehicles to build their electric vehicles, which in turn lowers a vehicle's performance as parts are not specifically designed with an electric powertrain in mind. Nonetheless, large incumbents still have the advantage of established capacity. But as most legacy OEM platforms have their base components focused for either light-duty or heavy-duty vehicles, OEMs have generally focused in their segment of core competency over medium-duty. Notably, most EV startups who went public through SPAC were at a very early stage in their business, being pre-revenue or pre-production, and the regulations on forecasts to investors were light, which encouraged ambitious multi-year forecasts and generous valuations. This set the stage for significant corrections as companies were now under public scrutiny to deliver results on a quarterly basis. As the first financials came for newly public de-SPAC companies, forecasts were missed drastically. Out of the 3 medium-duty EV SPACs that actually produce vehicles, top-line forecasts were missed by an average of 67.3% from their investor presentation. Though the early results were not favorable, the investment horizon to realize production at scale and profitability should be longer, something the private markets are more forgiving about over the public markets. But to achieve this over many years, companies should be well capitalized and have enough cash runway to reach production or revenue milestones. Currently, as of Q3 2022, most of the medium-duty EV SPACs have about a quarter of runway to realize their long-term ambitions. Specifically, with no revenue and at an earlier stage, companies like Arrival and Canoo will soon need to show traction in their product to raise more money before heavier scrutiny in continuing operations. Arrival's operations look to be particularly troubled as it is in the middle of its second restructuring in 6 months as it shifts from making vehicles in the UK market to vans in the US market. The company has struggled with setbacks with the recent vehicle fire witnessed by its largest customer, and has also received a warning from NASDAQ that it could be delisted. Adding to the underwhelming performance from lofty projections, additional representations made by public EV companies were later found to be misleading, if not downright fraudulent. In September 2020, Hindenburg Research released a short report accusing Nikola, the poster child for automobile SPACs, and its CEO, Trevor Milton, of making false statements about the company's technology in order to grow and partner with auto companies. The biggest claim of which was the company staging a video showing a prototype hydrogen-powered truck that appeared to be functional. It wasn't. The truck was towed to the top of a hill on a remote stretch of road and was simply filmed rolling down the hill. Not powered by hydrogen, but by gravity. Nikola founder Trevor Milton was later found guilty of 3 out of 4 counts of fraud on October 14, 2022, relating to false statements he made to drive up the value of Nikola's stock. The stock is now down 70% currently post de-SPAC. In November 2021, Workhorse, though not a SPAC previously, revealed that they were under SEC investigation related to trading activity prior to losing a major U.S. Postal Service contract where Workhorse executives and board members sold $60 million in stock before shares crashed. The SEC has since increased regulation on forward-looking statements from SPACs in March 2022, including more scrutiny on forecasts. There were many idiosyncratic drivers to the collapse in valuations of EV SPACs, but the macroeconomic driver that started the party soon changed course and stopped the music. After years of low interest rates hitting record lows during the pandemic, with increased money supply and stimulus, inflation was rampant, and in March 2022, the Federal Reserve began to increase interest rates at the fastest rate not seen since the stagflation of the 1980s. Growth stocks, particularly in technology, plummeted, and the EV startups that had just gone public the year prior were particularly affected as well. Conditions reversed as EV startups faced significant headwinds with a mixture of supply chain issues and unfavorable market conditions for raising fresh capital. Companies who had missed production and revenue projections were now in a market pushing for a path to profitability. It seems that many EV startups are in serious danger as the once rising tides for growth stocks recedes. So, what now? In this tough capital raising environment, EV startups that went public have had valuations decimated and will either need to raise new equity or debt to extend their runway or be acquired. Many EV startups will not make it to the finish line as they are forced to bankruptcy. Despite all of these headwinds in capital raising, electrification of transportation will persist. The commercial vehicle market is composed of many players, and the transition to electric will be no different, with the winners in the segment owning proprietary technology to significantly improve vehicle performance, or owning the production capacity of integral components to increase bargaining power with suppliers and achieve price parity for customers. At the same time, incumbent OEM automobile companies will quickly adapt their legacy diesel models to electric-powered modifications, but the players who focus on optimized performance for the electric powertrain will ultimately have a key advantage. In the pile of ashes of the EV startup landscape that was largely burned by the public markets and overly ambitious forecasts, there are already some players in the venture landscape that can potentially execute on their long-term plans in developing a commercial vehicle to scale with unique technology. In September 2022, Harbinger emerged from stealth, unveiling their medium-duty chassis that is compatible to support medium-duty body types, including commercial walk-in vans, recreational vehicles, and box trucks. Balancing its supplier strategy, Harbinger particularly stands out as they own the intellectual property and production of integral components in medium-duty vehicles with its proprietary drivetrain, axle, and suspension within its chassis, while partnering with key suppliers to support its full electric platform. Harbinger has recently announced partnerships with Wabash to supply truck bodies for commercial vehicles and last-mile delivery, and Autel Energy for charging solutions, which has allowed Harbinger to focus on its core technological moat of a differentiated electric chassis for medium-duty vehicles. Across the pond in Europe, Volta Trucks, a commercial trucks-as-a-service company founded in 2019 in London, finished its first Volta Zero in its assembly line in Austria with contract manufacturer Steyr Motive. The company was in its pilot phase and moved quickly into its production phase within 12 months, with final prototypes planned to be loaned to fleet customers throughout 2022 and into early 2023 for testing. The speed in which Volta Trucks has progressed is impressive, but its strategy seems to be reliant on third-party suppliers, and it remains to be seen what technology it actually owns. Volta Trucks seems to follow in the race to assemble strategy like previous EV startups, so its supply chain partners may bring future headwinds as they enter commercial production. After the dust settles from the value destruction of early-stage EV startups going public too early at nosebleed valuations, the inevitable fall has been accelerated by macroeconomic drivers. Legacy OEMs have focused most of their efforts in light-duty and heavy-duty vehicles, with some automotive companies in the medium-duty segment adapting their diesel platforms to electric with unoptimized designs. The medium-duty landscape lacks a clear segment leader and is ripe for new entrants with a unique technology platform to capture significant market share in the electrification of the world's commercial fleets.